Good afternoon, everyone, and welcome to this session on our accounts rules, which is part of our virtual Compliance Officers Conference week. So this is being run as a live session, and we want this session to be as interactive as possible. So to ask your questions, you just need to click on the link down below the broadcast and submit your questions. It's always nice to know your name, so if you're happy to, do share your name, but of course there's no requirement. So just some quick introductions. I'm Liz Rosser from the SRA, and I'm joined by my colleagues Taranjeet Singh Babra from the SRA as the Forensic Investigation Manager, and Janet Taylor from Taylor Mowbray. And Janet is here to bring us the views of the reporting accountant. So in terms of the session, we want to provide an update for you as there are some changes in progress at the moment with the accounts rules, and also to show you the kinds of issues we're seeing in terms of compliance. And most importantly, as I said, to answer your questions. We've been waiting, had quite a few questions come in, which is great, but do please submit your questions as we move through. So as I said, there have been some changes. There's been a recent consultation on changes to the accounts rules. So perhaps Taranjeet, could you explain a little bit more about what we consulted on, what changes are being made, and when they're likely to come into force?
Thanks, Liz. So we consulted on a number of changes to the accounts rules, and most of them were to put into place what was guidance, where we'd identified there were some issues when we initially brought the rules in. What we've proposed to go forward with are changes to rules 2, 4 and 10. 2 and 4 relate to client money in particular, and 10 relates to third-party managed accounts. Sorry, not third-party managed, joint accounts. We were just talking about third-party managed accounts before we started. That's why I got confused. So it relates to client's own account operating joint accounts. So the rules or the proposed changes are currently with the LSB. We're waiting on approval. Once we have approval, there will be some running time. So it won't just be the date that the LSB give approval. We will give some notice about when the rules are to come into effect. In respect of the rules, in respect of rules 2 and 4, I guess one of the key changes is into the definition of what is client money. So the rule as it stands says it's client money is money you receive on account of costs. But what we changed that to, we're going to change it to put the word incurred in. So it's still going to be client money on account of costs until you've incurred those costs. So just sending a written bill doesn't make it business money or office money. You have to have had incurred those costs for it to actually become office money, and then make that transfer. What that doesn't do, it doesn't change the rule 2.1c, which allows you to come to your own arrangement with the client. So you can come to your own separate arrangement with the client. So for example, you've got a long established relationship with the client where the client agrees you're going to bill and take the money in advance of doing the work. As long as you've got that documented with the client, you've explained to the client what's happening and they've agreed to it, you can still come to your own separate agreement on that. The other change is in respect of recharges. So mainly applies to where you've got portal accounts. So for example, land registry, or if you're using other portals, whereby you are just reclaiming the cost of, say, your land registry fees as they come up. You don't have to send a written bill or notification of those costs. You can take those costs as and when they've occurred. So when recharge, you don't have to send a bill or a written notification. You can transfer that from client office as and when you feel it's appropriate. The other big change, or not big change, the other change relates to operating a client's own account. That's rules 10. And what we've done is put into place what is guidance, and it's more around your record keeping, which means the proposed change is going to be that you keep records of all bills you issued, of any transfers you make through the account, any activity which you operate through that account. And you keep detailed records of that. And then every 16 weeks, those records are checked and signed by a manager or a COP. What those records are, it doesn't state it's got to be a reconciliation, but it's got to be some kind of a record, so be a ledger or some form of document where a COP or manager can check the transactions through, they match to the bank, and they can sign that off, and that's got to be done every 16 weeks. And they're the main changes that are going to come into effect in respect to the client's account.
Okay, thanks. So, Janet, have you had any issues or queries from firms regarding rules 2, 4, and maybe in particular 10, and that you think these proposed changes will help to clarify?
Yeah, I think my sort of comments around most of this are that when it comes to rules 2 and 4, and there has been that need to bring some clarification into what was in the rules. And I know the guidance was there anyway, but it's often that firms are a bit more comfortable when they see it in the rules themselves. The main confusion was initially, really, so we are going back a little bit now, and the SRA have commented and put the guidance in that made it, reasonably clear, I think, anyway. And I was certainly comfortable with where you didn't have to send a bill in advance for disbursements that you had incurred and so on. And that links into Rule 5 anyway, that says as long as the money is used for its intended purpose. So some firms were kind of going a bit overboard initially because they thought there was something really serious here, but seem to broadly be dealing certainly with disbursements and so on, those recharges in line with the guidance that's been there for, gosh, it must be nearly 3 years now, probably. So that's been great. So I think this is just really making sure that's effective within the rules and just that little bit of extra clarification, which is really good. The definitions around money that was received being the firm's money just because you billed it as opposed to having incurred it under Rule 2.1D, I think is a really useful one, because I think maybe the way I might describe it is maybe some of the cashiers and bookkeepers felt like there might be a lack of discipline amongst, fee earners around this, and they think, well, this is fine, the client said this, let's get money in the business account, and we can have a very nice Christmas party this year or whatever. But I think that's, again, I think that was certainly something that my clients are happier to see, and that consistency between those two rules. So I think, broadly speaking, that people are pretty much cracked it, and hopefully will carry on, but it does give them that clarity. I think absolutely, and I think everybody has been aware that the client's own account issue has been a problematic one, and a lot of firms have worked very, very hard to get those things to a far better state than they were prior to the 2019 rules coming in. Certainly as reporting accountants, we've been looking at this quite a lot. And I think, I can't remember how I described it in the sort of in-person session, but I wouldn't say we've been overly gentle, but we've been a little bit of a, possibly 2 or 3 strikes and you're out attitude when it comes to reporting. Come on, let's see what you're doing. Let's see what you've got in place. Yes, we recognise you might not be able to do full reconciliations. And obviously, as Taranjeet was saying there, there's a shift away from that anyway to looking at reconciling the transactions you're involved in. Firms have really got to have something decent in place, and so there haven't been a lot of qualifications, I don't think, from most reporting accountants, but we're sort of saying, look, you've had lots of opportunity to at the very least get a register in place. If you haven't got a register of all of these, then I mean, to be perfectly honest, that's a serious issue. You should know how many of these you're operating and who's operating them. So we've been I think we've certainly been making strides with that, and the accountants have been looking to help firms do that. But I think firms will certainly feel a bit happier with what they're going to have going forward, assume that goes through the position at the moment. So I'm hoping onward and upward, but yeah.
I think was that when you talked about yellow and red cards, I think.
Oh, that was probably session. It, yes. I probably might have given them, a bit of a VAR, and it could go on for quite a while. Might have even given them a yellow and orange and now into red. So don't be in the red zone.
Now be careful of those red cards. Brilliant, thank you. So Taranjeet, are we seeing any issues in respect of firms submitting accountants' reports?
Unfortunately, we are seeing some issues. So it's only qualified accounts reports that get submitted to the SRA. The duty is on the solicitors' firms to do that. Some accountants will do it on their behalf, but the firm should make sure that the accountant's done it. The onus is on the solicitors to do it. What we have seen, unfortunately, is a trend where there's been no submission of where there should be. So a firm's received a qualified accountant's report, but not submitted it to the SRA. We've seen a pattern of late accountants reports, so they're catching up. They've been 2 submitted at once without any application for a delay or a waiver to delay the submission of one. So we have seen that pattern. We expect firms to be submitting any qualified reports on time. I think what I'd say around that is not every qualified report results in further action. They are reviewed, and a risk-based approach is taken. So it doesn't mean because you submit it, something's going to happen on the back of it. But what's probably worse is if you should submit it and you don't. So it's better to submit it than not submit it, is the key on that. And even better to submit it late if you're not going to submit it at all. So try not to be late and submit the accounts reports. They're the main two things.
But better late than never.
Yeah.
Yeah. Okay, Janet, are you seeing any themes in the work you're doing when completing accountants' reports?
I mean, yeah, traditionally are sort of various themes, and obviously a bit later on in the session we're going to talk about the sort of individual types of breaches. But I think some of the key things I think are worth mentioning from what I see and what my colleagues who are working in this arena see as well. There's certainly, I think, one area where there is still confusion by firms and by reporting accountants, for certainly, so particularly those who maybe don't do very many of these, it is whether or not there is a specific requirement in every case to send a cease to hold report. So you see people sort of doing a lot of toing and froing there, and Rule 12.4 doesn't specifically require one. It makes the comment that the SRA will determine whether or not a cease to hold report is needed. But certainly, again, what I say to my clients on this, or anybody that raises a query with me, is don't sit back and wait to find out at some point whether or not the SRA want one. You should be proactive in this, providing them with the information so they can tell you whether or not one is going to be needed. It's better from a planning point of view to get the accountant in, but also it just means the firm knows what the requirements are going to be. So I think that's something that does come up reasonably regularly. I think the other thing is still a little bit of resistance from some law firms to the reporting accountant coming back into the building to do some of their visits. So obviously when we had the lockdown situation and things were done remotely, and I know that a lot of working practices are hybrid and so on, but I think that whilst it's great, and quite a lot of the work and sample selection and some of the initial work can be done remotely, and you can have a sort of face-to-face Teams type meeting and so on with the client, that my view, and again a lot of my colleagues that I speak to still take the view that it is better for the accountant doing the work and it's better for the firm if there is some visit within all of that. It's not like the old days where we pitch us tent for sort of 3-4 weeks or something and drink all the coffee and all the rest of it. It might be a very short pass. It might be a day in some circumstances where you're out there because you've been able to do everything else. But I think it's really important for the accountant to see the mechanics of what goes in the firm, how things operate there. And I think, again, talking to lots of cashiers and bookkeepers about this sort of thing, they actually like that presence as well. It's quite nice, quite reassuring. Often queries can be dealt with very quickly, where a lot of toing and froing when you're sending emails to us about things isn't necessarily always as efficient and effective. So I think that firms should look to see that there is value in actually the accountant visiting as well, and have the conversation about what will you be doing then, how's it best going to work, how do both their reporting accountant and the firm themselves get the best value out of that. Good reporting accountants, we're continuing sort of reviewing our procedures, how we do our work, what's the best way to go about things. We're getting better because firms have better software and so on for a lot of this, to be able to interrogate the software a little bit more into the risky areas. So I'm only going to mention this in passing now, but things like residual balances, that we can interrogate and have a look at that, so we can focus on risk areas. I mean, we still look at the whole system, but we can do that. So we're continually, hopefully, refining things. So again, I always think it's a good idea from the law firm's point of view to make sure they have some conversation with their reporting accountant at the outset and talk through some things that they might see as risky as well, where they want some review and confidence alongside what the accountant's going to do. Because it's not cloak and dagger stuff. It's like we're happy to say, look, client-to-client transfers are risky, and this is why. So we will be picking them, you know, and so firms can understand again what they can, if you know, hopefully they can take some of what we do for their own internal procedures and review. So they're sort of some of the themes that we're seeing in terms of the going out doing the work or issues that might arise, you know, outside of the specific rule issues anyway.
Great, thanks. And I'm sure we'll come back to residual balances based on previous sessions. So there's some of the themes you're seeing. And Taranjeet, in terms of the qualified accountants reports that are submitted into your team, the Forensic Investigation Unit, what themes are you seeing?
Yeah, so what we've seen in terms of themes, so since about 2019, we've seen a trend where we're getting fewer and fewer. But what we're getting through are the correct qualifications. So I think the guidance we put out there for reporting accountants, I hope Janet agrees, shows that the reporting accountants are in step with what the SRA is asking them to check. So that's a real positive. In terms of themes, what are coming out of the qualifications, in no particular order, Janet's already mentioned this, residual balances comes up quite a lot. And that's about firm systems and controls in not dealing with residual balances and just letting them build up. And then it gets to the point where the reporting accountants probably issued the yellow and the red, the orange card, and it comes to a red card and that comes out. So that comes in. I think they give them a chance. We also get reports on things like suspense accounts and poor control environments. And this could do with not carrying out a full three-way reconciliation. Again, inappropriate use of suspense account, having too many debit balances and not rectifying them, similar with office credit balances. They've got unrectified differences. All of that is about control of the accounts and the records. And the reporting account will obviously report anything where they identified a client account shortage. They will come through as well. They're the main themes that we get coming through as we see them when they land on our desks.
Okay, thanks. Janet, anything to add to that?
Yeah, not surprisingly, there's a huge overlap, which is how it should be really, between what the SRA and what the FI team that Taranjeet Vinson see in terms of the breaches that come to them and what we see. And as he mentioned, whilst it is the reporting accountant's own judgment whether they think something is serious enough to report, so there is, that's the way we do use the SRA's guidance around all of this that they provided for us, and very much that's there's a number of scenarios where maybe it was a bit of a build up. So if you haven't seen improvements, you might not necessarily be looking to qualify immediately if we can see the firms trying to sort things out, particularly on residual balances was one. But actually, if you don't see that improvement, there's a point it hits and we say, look, it's you're clearly not getting to grips with this. I mean, there has been an interesting case recently around build-ups of those as well. So yeah, quite certainly a fair old crossover between all of that. The couple of, I suppose, other things that we look at. So I suppose in a sense, not so much part of our sort of looking at a rule compliance and breaches, but feeds into what we do and feeds into the recommendations we make to firms is we will always look at breaches register of a firm when we go out there. I think some firms think that we're trying to just let that do the job for us. Oh, here are the breaches, we'll have those, which is not. It's all about our risk assessment, our understanding, but also looking at what's on there. And I would say that although there are lots of different pro formas, really good ones that firms can make use of, I do see a real mixed bag of quality when it comes to breaches registers. And I always think it's such an important tool for the COFA to have to ensure that they know, when did the breach arise? At what date was it spotted? When was it fixed? How much was it for? They can see patterns and so on, whether they're fixed or not. That the sort of sometimes lack of information in those I would say, I wouldn't be happy as a COFA to sign off and say, yeah, I'm quite happy with our systems and controls. We'll just wait till the accountant comes in at the end of the year. I would want to know that I haven't got any patterns of issues and so on. So I think that there's a reasonable bit of room for improvement in some firms. Some are obviously brilliant, and I'm sure everyone on the calls are brilliant. But, it's nice to know what everybody else is doing wrong, isn't it? That's what we're all to hear about what everyone else is doing wrong. And then the other one of my other little soapbox areas is in relation to having decent written policies, proper written policies. The accounts rules now, when you've got, far fewer rules, they're principles-based rules. Yes, there is some detail there, definitely, and definitely some really important detail. But they provide a framework for a firm for compliance, and onto that framework you have to hang your policies, your procedures that are best for your firm, your firm's clients, to ensure compliance. And I still see firms that will say things like, well, we've just used the old rules, the pre-20, and you think, well, no, that's no, is basically the answer to that. No, don't do that. Think about your firm. And I mean, certainly I think it is absolutely completely 100% fair to say that that residual balance is one. So the SRA, as Taranjeet says, that's one they see quite a bit on as well. Where firms do best at dealing with the balances in the first place, so they become residual, and then the residual balances, should they arise, is where they've got really good written procedures to close down the files, short time frames that everybody's aware of, everybody's trained on, everybody knows what's expected of them to sort this out, and people don't sort of come in from other firms and do what they did there. That definitely, and that saves time, it saves money. There's a commercial imperative as well as a compliance imperative in having those sorts of things in place. So regularly review your policies. Your accountant will be looking at your policies to see whether, one, if it's reasonable in the first place, in their humble opinion, was reasonable in the first place, but also then, well, have you complied with it? I always think it's, people used to moan a bit about the old rules and say, well, they're so prescriptive and they're one size fits all, and that's no use to us, and there should be a little bit. And so on occasion, when somebody would say this very detailed rule is written like this and that doesn't work for us, I might sympathize a bit and think, well, yeah, no, it could be, I can see why you haven't done that, and that's maybe not. But to write a policy yourself because it's the right one for you and your clients, and then not follow it, well, I can't find an excuse for you there. So, I think ducks in a row is probably a way to describe that. And I think that links into the breaches register as well. So COFAs can see, well, are the policies working as well, or have we got something we need to do there? So yeah, I'd say I am sitting down, but otherwise I would have been stood on a soapbox that I shall climb down from now.
And I did get the sense after our live session that everyone was scurrying off to check their breaches registers. So everyone wrote that down. So yeah, I'm sure it's made a difference. So good stuff. Thanks, Janet. So Taranjeet, the FI officers also go out on site. So what kind of things are they seeing when they're out on site visiting?
Yeah, just before I go on that, can I just say I joined Janet on the soapbox. Happily hold your hand on top of that soapbox with you all day long. I completely reiterate what Janet just said there. So what we're seeing when we go out, there's not been much change in terms of that over the last few years. We're seeing issues with compliance with the money laundering regulations, using the client account as a banking facility, Rule 3.3. We see that quite often. Like I've mentioned earlier, we're seeing instances where we're going on site and seeing that they should have submitted an accounts report and they've either just not got it done or they've had it and not submitted it. So we're seeing instances of that. We're still seeing some solicitors, unfortunately, get involved in some investment schemes where perhaps they shouldn't be lending their name to. A lot of financial stability issues coming along with accumulator firms, as has been well reported. So we're seeing more of that. We've seen issues with immigration advice given to clients, and what we always tend to see, one of the repeated patterns, is what I said about earlier about poor accounting controls and systems. So not doing your reconciliation properly, not having your ledgers properly written up, debit balances. Those accounting type issues are quite often come up when we're on site.
Okay, thanks. And you mentioned Rule 3.3, which we always talk about at these sessions. So the use of client account as a banking facility. So Janet, this has been around for a number of years now. Are there any particular areas of application that you think are causing concern?
Yes, I mean it is one that certainly when you're doing training, it's by some distance the one that comes up with the most questions and so on. I think it's good to see that if I go back 4 or 5 years, and we have 14.5 and moving into this, what I have found is definitely far more situations where the well, often the accounts team in the law firm that come through with the question, but firms themselves getting advice before they do something far more commonly than they used to. So it might be from the reporting account, it might be going to ethics and so on. So there's definitely, as you'd hope, more awareness around it, which is not to say though that you don't still get some of the basics going wrong in some firms where clearly people haven't had proper up-to-date training. So there are quite a few areas around this. We've got the new warning notice and the new case studies have been issued recently, and we're talking at the moment with colleagues of Taranjeet's as well around perhaps some other things that we could put in there. It's one of those areas where I think it's the people have to be careful. There are some things that are very obviously a banking facility, but you've also got to be careful that actually small changes to what you're actually doing in a transaction might make it okay and not okay. So people do have to be very alive to it. Because they can be quite nuanced, a number of these. It's always a difficult arena in something like that to pick on specific, so I tend to have to get into a lot of detail with people. But if I give you a hit list, I suppose, of things that the main areas of a breach that we tend to see as reporting accountants, not, some of them are for very big amounts have become serious and we're reporting to the regulator. But I would say that the most common ones are firms at the request of the client, making gift payments out of proceeds and so on, perhaps to family members, to particularly offspring often as well, who are now going to buy another property rather than giving that money to the client and the owner of said property, paying unrelated liabilities out that have nothing to do with the legal work, again at the request of the client. Companies, directors, particularly for private companies, directors for personal matters versus company matters, shall I say, getting confused and not realizing they're entirely separate clients, but transfers between, retaining money on aborted matters for long periods of time, or matters where nothing actually has been instigated as yet, acting for trustees rather than as trustees, and not appreciating there is a difference there in terms of what you can perhaps hold and what sort of payments you can make out, and situations where the client says we haven't got a bank account, so can you pay it off to somebody else, for example. They're probably the most common ones that we tend to see in practice and that we're advising clients on. So I think it's great, the SRA, to build up a sort of bank of those sorts of things that we have the sort of warning notice and case studies around. But yeah, it'll run for a bit.
I'm sure you're right. So I think I'm going to turn to some of these questions now. We've got quite a lot of questions coming through the feed. So first question, the one we got first, actually, we're reaching the point for interest to be paid to clients based on our de minimis more quickly and more frequently. What would be the SRA's view on increasing our de minimis, and what does the SRA deem to be the maximum reasonable de minimis value?
I don't mind having a bit of a go at this one, and then if Taranjeet wants to sort of add anything. I mean, certainly, I think, not casting any aspersions or anything here, but it's certainly one of the things that has come up quite a lot. So obviously, somebody's asked, we have seen it a few times, is obviously interest rates have, been so low for a long time. Even with a de minimis of £20 or £50, which is probably the most typical de minimis I see in practice. Firms they haven't hit anything for the length of time they held the money and how rates have been. And now obviously interest rates have improved, which means clients themselves are more aware of the issue, probably in many cases. But there is that sort of point now where actually at that de minimis, with interest rates as they are, we're now going to have to pay it more often. Now, there's nothing wrong, in my view, of increasing your de minimis if you've got good reason to do so. If you've been very low end of de minimis, you're not in line with everybody else. But I think what a firm should be very careful about, and anyone should sort of ask themselves, is, are we really only looking to increase the de minimis to avoid paying interest now, or some in lieu of interest, just because it would hit because interest rates have gone up? And I don't think that, if you think about professional view of it, you know, what were the principles behind the rules and so on. I mean, my understanding is the SRA would never, you know, it does say a fair and reasonable amount, and you can have a de minimis. I don't think the SRA would say that's an appropriate de minimis. You know, there's an element of horses for courses. And what might be an appropriate de minimis for one firm for the sort of clients they've got might be very different to a firm, I don't know, to firm that's only got massive corporate, multinational corporate clients and coming to a separate arrangement with them. And bear in mind, you have a policy, but you can come to a separate arrangement with other clients, which might be not paying them interest. If you're doing a, you know, several £100 million deal for them, they're probably not interested in, you know, £55 of interest on it. But I think the thing is, you've got to look carefully at it and consider why it is that you think your existing de minimis is rather low. I think the highest, I would say the highest I've seen as a policy de minimis is 100. But that's not the most common. The most common I see is either 20 or most typically 50 now. And I would do that there in terms of what's the right level.
Taranjeet,
did you want to add anything? Or I'm sure that's right, we wouldn't give a value.
Yeah, we wouldn't give a value. I think the whole point of the new rules was to allow firms to put policies which are suitable for them. And as Janet says, some corporate clients, it will cost them more than £55 in interest to process a cheque for £55. So they're quite happy to waive the interest. So it's got to be what's in the best interest and right for your client. And I think, just to reiterate what Janet said, just because interest rates have gone up, it shouldn't be the reason to change your de minimis. There's got to be some more thinking behind that to justify if you're going to change it now.
Yeah, sure. Thanks. Okay, another question here. Can we use third-party managed accounts that are not run by non-FCA authorised organisations if considered in the client's best interests? If so, do we need to inform the SRA as we do for other TPMA arrangements?
I can take that if we're happy. It's quite a simple answer. The answer is no. The definition of a third-party managed account says it must be regulated. The provider must be regulated by the FCA. So the third-party managed account provider has to be regulated by the FCA. So, yeah, that's the answer to that.
Okay, lovely. Thank you. Okay, I've got a question here from Jennifer. For three-way reconciliation on clients' own accounts where we're not the sole signatory, for example, if we're a joint attorney, it is unclear what the reconciliation should be run against. We do not currently bring these accounts into our systems as we do not have complete control over them. Is there any guidance on how to undertake such reconciliations?
Again, I'm happy to have a go at that, and Janet can correct me or add to it. So we'll talk about the change in the rules, which is what the guidance is doing, is putting the current guidance into rules. And one of the key things is we're taking out the need for a reconciliation. It's now about your record keeping. So you don't have to reconcile, but you have to keep records of what you undertake through that bank account. So if you issue a bill on that client matter and transfer it from that client bank account, you need to keep a record of the bill and the money transferred. If you make a payment through that third-party account, you need to keep a record. It's what you are doing with that account, and you need to keep records. So whether it's incorporated into your account software or on a separate handwritten ledger, you need to keep those records. And then those records need to be checked and signed by a COFA or a manager every 16 weeks. And any differences from what you've done at the bank and what's showing on your records need to be investigated. So no need for a reconciliation, but you have to keep records, and that's going to depend on what you do. So practically speaking, you probably have a ledger, and that may be enough, but it depends on how many you do and what's practical for your firm. I don't know if Janet's got anything to add on.
Yeah, I mean, yeah, we see quite a few where people perhaps use, you know, something like Excel to, you know, that type of spreadsheet to keep the record of those and the ledgers for those. And you're saying just show that they've checked against their, you know, the transactions and the details that they've got there, the payments that they've made themselves. So I think that shift away. And again, I think the guidance around it had picked that up, even though, you know, the existing guidance still refers to the 5-weekly element of it rather than, but the new rule will obviously change that. But it did talk about, you know, having a look at it on that basis. And that's what we've tended to look at as well as reporting accountants.
Okay, thanks. Another one probably for you, Taranjeet. Must the incurred costs still be billed before transferring into the office account?
Yeah, so that part of the rule isn't changing. So before you transfer any money, you've got to send the client a bill or other written notification of costs. So it doesn't necessarily have to be a bill, but the clients have to be informed in writing of the cost of the exact amount and what it's for. So whether you've done that at the outset in an attachment to your client care letter or however you've done it, as long as there is some written notification of the amount, and it's got to be the same amount you transfer, that's fine. So it can be done without a bill.
Okay, thank you. Janet, we've had this anonymous question. Does this session only apply to firms that have a client account? Are there any scenarios where firms with no client account need to be aware of the accounts rules?
Yeah, that's an interesting one because with no clients account, this is not for me. But there are issues that are definitely relevant whether you have a clients account or not. So there is there's an ethics guidance note around whether or not you need a client account. So and there's a definition in the rules that will allow you, and still with the rule changes, allow you to not have a client account as long as the only money you receive from clients is money for billed fees that have been incurred, or you've agreed with the client, as Taranjeet was highlighting at the outset, that if you bill them in advance, the money can be held outside of client's account. But that would be that's the only type of money. So if you've got any transactional money's coming through and so on, you'd have to have a client account. However, so if that's all that you do, you literally, it's a case of we do the work, we bill the client, they pay us, or we do the work, they've agreed the bill in advance, the work we're going to do, and it can go on the office account, we do that, then that still doesn't mean you can ignore the rest of the rules, but you don't have to have a client account. But what you've got to be aware of is that you are regulated, you're acting for clients, and the office element or the business ledger side still needs to be maintained in accordance with what the rules say about this. So you've still got to make sure that you're keeping all those records as well. You will also need to, for example, make sure that if you have a breach, so if money has gone if you've got money, let's say, in the account and you shouldn't have received it at all, then you fix that promptly. So those things are going to apply. There are a number of bits of the rules. I won't list them all out, but there is that guidance note that says, do I need to operate a client account, and then talks about things you still need to concern yourself with. And I think the key thing that I would probably say is that if you don't have a client account, what you need to be very mindful of is that everybody in your firm knows what sort of money you are allowed to receive in. Because it's all very well saying we don't have a client account because we don't receive in client money other than that we're allowed to sort of put into the office account. Everybody will give obviously the office account details to their clients and so on, without necessarily, if they request something else from the client, realizing that can't go in there. So it's really important to know what you can't do outside of that, as well as what you can do, so that you don't fall down any. And then of course, if you are going to receive money that doesn't fit that criteria, you're going to have open a client account, or you're going to have to find a different way for the client to pay that. So then paying the third party direct or whatever else it might be, or use TPMAs, of course, is the other thing I ought to mention. So yeah, I'd say definitely be aware of it, definitely understand, still have to have written policies to deal with things. You can still have a residual balance because they've given you some money and actually didn't end up doing quite as much work for them and so on, and it's in the business account. You still got to pay money back promptly following conclusion. So have a look at that, make sure you've got policies for all of those things, and don't assume that haven't got a client account, don't need to worry. I think and say Taranjeet, there might be some other stuff I
think you covered it quite well. It's like I said, I think one of the biggest issues is making sure the firm are fully aware, everyone's aware that you don't operate a client account, so you don't accidentally take on a friend's conveyance, for example. When you don't do it because you're trying to help someone out, you need a client account to do that. So you need to be quite strict and have clear controls when you're not operating a client's account. And
I think that's it, given that we know that many of the reasons why Rule 3.3 3 gets breached because people are trying to be helpful. I can just imagine that being, as just you just said, that'd be precisely why somebody might do this, Rob, because they're trying to be helpful.
Yeah.
Great, thank you. So a question here from Tariq Rashid. What should a firm do if the accountancy firm does not meet the deadline? Perhaps I should address that at Taranjeet rather than you, Janet.
I was going to pass that to Janet then. So I think the key thing is obviously find out why from the firm and then contact the SRA. Engage with the SRA. If there's a genuine reason the accountant's been taken ill, that there's been a bereavement, something's happened that prevents them, we'll understand that. But I think you need to engage with your regulator, you need to engage with the SRA, so we're aware of that and we can update our records accordingly. We're not going to come down on you like a ton of bricks because the account's been a bit delayed, but you need to find out why and then engage with us.
Perfect, thank you. Another one on interest now. What's the position on client interest where it is interest in the general client account, and can this be office money?
Yeah, I'm happy to deal with that.
So,
yeah. So interest on a general client account is office money unless it hits your de minimis for any particular transaction, because a general client account is a pooled sum, so where you pool all of your client money together. So the general principle is that interest you earn on that account is office money. So some firms will have an overnight high interest account, for example, where it's a business model where they will transfer the money overnight. It still complies with all the rules as it's immediately available. It's not ring fenced. There's no time limit to request those funds, just to earn a bit more interest, and then they bring that back into their client account in the morning. So the interest you earn generally is office money. You just need to be wary. Obviously, if you hold large sums for a long period of time and hit your de minimis, they're the ones you need to consider that interest, or the de minimis could be the client money. And the other issue to that is if you have a designated client account, or designated deposit client account, should I say, that is client money, because that's an account set up for those specific funds for that specific client. So general client account, it's office money. Designated deposit accounts, it's straight to the client. But banks generally know when you set up each account what they're doing with that, because they do so many of them.
Great, thank you. If you're holding large sums for a client and can't get hold of them, what's the process for transferring these to a nominated charity, and what steps should we take?
Should I mention? I'll say something on that one, I suppose. Yeah, I mean, I'm quite happy to. I mean, the key thing there is that there's two. There's the rule itself that refers you to prescribed circumstances for dealing with balances up to £500. So then there's the guidance that will explain what sort of things you ought to be doing before you self-certify, so you've got to look and see, depending on the amount of the balance, what would be a reasonable thing to do. I mean, if you can't trace the client, for example, and so on, I think minimum DWP, letter forwarding type thing. So there's quite a few sort of things in there to help you self-certify. But I think firms have to realise it is a self-certification. And again, if you've got a policy written that for balances up to X that we've been on, this is all the steps we will take before we would conclude we can't repay the money, and balances between X and Y and in a step thing, and people follow that, then you've probably got pretty good evidence to say, look, we have done everything reasonable before we self-certified and paid over to charity. So the guide that prescribed circumstances note does sort of refer to those things, but it is mandatory. You've got to do something. It can't just languish there forever. And you pay it over to charity, get receipts from the charity. The charity, you don't have to pay those balances, those individual matter balances up to £500 to a charity that will indemnify you, but you're absolutely at liberty to do so. But you have to bear in mind that if you don't get an indemnity and the client pops up from, they've been in Australia for the last 7 years and that's why you couldn't pay the money to them, and they say you owe me £62.40, then you are you have to pay £62.40. Obviously an indemnity will otherwise cover that. If it's more than £500, I mean, Taranjeet might be able to comment a bit more on this than me, but effectively, again, there's the guidance note that talks about the reasonable steps to take before you apply to the SRA for permission to pay those funds over to charity. And then again, it's what's reasonable steps. The higher the balance, then the more you reasonably expected to do. But it'll depend on how old they are, how they've been generated. Is it some firm that you merged with 15 years ago and nobody knows? Heaven forbid, that sort of thing was lurking anywhere, she says, because I can't see any of you in front of me. I can't see the whites of your eyes, so I don't know if there's that'll be us. So there's quite a bit of guidance to do that. But I think the thing that I always say to firms is, have a decent policy about what you're going to do. Make sure it's properly followed through, and bear in mind you are self-certifying for those smaller balances. Can you stand up and be counted? It's been reasonable. For those bigger balances, think about again what's been sensible. Make that application to the SAR. Don't duck the issue and think, oh no, we don't want to engage. It's better to get it sorted. And I know from conversations I've had with Taranjeet's team and so on in the past, is if firms have done something reasonable, I think the FI team, in my understanding, is they would rather that part of the SRA that deals with it says, yes, pay it to charity. They don't want it. The risk when it sits in client account of other things happening, I think in my 30 odd years experience is not good. So so I think that's it. It's make sure you follow all that through. The reporting account, just as a side thing from the reporting accountant's perspective, whilst you can ask us what we think is reasonable for you to have done, we and no doubt will have an opinion. We don't report specifically on that. We will make sure that factually you have done the correct thing. So that was the client whose money was paid over. It was paid to that charity. You got the receipt for it, etc. We don't sit there and sort of agonize over what we think is reasonable. So but there is a reasonable bit of guidance there.
Okay, thanks. Taranjeet, did you want to add to that? Or
no, I think Janet's covered everything there. I think the key principle is the amount is relative to the amount of effort you put in. So for larger amounts, you might have to incur a tracing agent because that's a reasonable thing to incur. But for a small amount, you wouldn't go to that effort. So it's relative to the amount of money you hold to the amount of actual inquiries you have to make. But professional ethics who deal with the waivers, you can engage with them from an early stage and they will give you guidance as to we can deal with this much now, or you need to take further steps on it. So it's not we make one application and it's done. It can be an ongoing process.
Yeah, and I think that's a bit of a takeaway from quite a few of your answers, is it's better to engage and to talk to us, isn't it?
Yeah.
So I think that's a good takeaway. So another one for you then, Taranjeet. What would count as too long to keep funds in the client account in situations such as an aborted purchase?
It would depend on the circumstances. If the purchase is aborted and they've got another one lined up, well, that's fine because there's going to be an instruction. But if they just say, hold on to the money because we're going to find another property, we don't know how long it's going to take, you're at risk of creating yourself a residual balance, and you're also at risk of starting to act as a banking facility. So there is no exact time frame to say, look, 30 days, 60 days, 10 days. It depends on the instructions. And if you're not getting instructions, or they say they're going to come and they don't come, then the safest bet is to return that money, give it back to the client. They can instruct you again. With online banking, it's quite straightforward to do. So I think the best case scenario is as soon as the purchase is aborted, unless something's lined up, send the money back. But if they told you we've got something else lined up, the client, they're a regular client, or they found another property, then you can hold on to it for what will be a reasonable period of time. But I wouldn't be able to say because you need to see what they've come back to you with.
Okay, good advice, thank you. I feel I'm firing loads of questions on all sorts of topics at you, so well done. We've got plenty more. So here's one from Lucy. Can you clarify if payment of probate related expenses, for example survey evaluations and property clearance, does not fall foul of Rule 3.3 and providing a banking facility as they're connected to the administration of the estate? Taranjeet, another for you, is it?
Yeah, that's fine. I think this is because it's linked to the transaction and it has to be done. It's not providing a banking facility because you're not doing you're doing it to progress the underlying legal transaction. So you're paying a probate fee so you can deal with the administration of the estate. You're paying a surveyor's fee so you can deal with the conveyance. So there is a link to the underlying transaction. It's if you were paying, I don't know, a car payment when you're instructing a conveyance, that's not linked to the transaction. It's something completely separate. So with probate fees, surveyors fee, estate agents fees, they're all linked to an underlying transaction. Then that's fine. That's not providing banking facilities.
Okay, thank you. Now, this is just to prove that this is a live session. So we've had a clarification question. So our earlier question on third-party managed accounts. So the question was not, does a TPMA provider have to be FCA authorised, but rather, can we use an alternative to a client account and a TPMA? i.e., can we use another option which is not a client account or TPMA as long as it's in the client's best interests? Taranjeet, do you want to take that?
Well, I took the original one, so I'll take the follow-up one. Janet's laughing. Okay, so there are a number of factors to this point, because the first being is if you receive that money, it becomes client money under the definition. If you hold a received client, it becomes client money. So therefore, you, under the principles, are obligated to protect that money. So if you put it into another provider, you have to ensure that that provider has got sufficient protections for your client. So if they're not FCA regulated, how is that money protected? Is there some kind of insurance backing? You'd have to look to take those extra steps to say that that money is protected, as well as it is protected in the client accounts. The client account has a comp fund. Obviously, the FCA have their own regulated services. So if you're not choosing to use that because it's the client's best interest, you have to really document how it is. And if you receive that money, it then becomes client money. So it puts even more of an onus on it, because then the principal's on the firm as well to protect that asset. So if you don't give it to an FCA regulated entity or an entity that's regulated, is how is that protecting that asset if something happens to it? So you're opening yourselves up to more risk potentially. There's nothing to stop you doing it if it's the client's best interest, but the risks, you do put yourself into another level of risk, a higher risk platform. I can think of a word on the spot. If you're going to attempt to do something like that. And if Janet's got anything to add to that, we can.
No, I think that's it. I mean, I think the rule, there's always been that bit in the rule, hasn't it, that says that, client manager going to client, you can come to alternative arrangement with the client, but the overriding thing is, and that would be an individual client. So if somebody's looking to say, I want to avoid having a client account per se or TPMA per se, it's very difficult to see how that for all the clients that you use, getting them all say, no, I actually want my account in, I don't know, an account in Jersey, which doesn't fit the definition of client account, for example, would be fine across the piece. So that was always a very kind of limited one anyway, wasn't it? To say, well, because you've got those further obligations, as you say, beyond just what a client might be happy to accept, as it were. So yeah, I think that's probably the only thing I would say that sometimes you see people arguing for.
Okay, thanks. Can you only have one client account?
No. I think it's probably No, I just thought I'll nip in there. That's an easy one. Yeah, you've probably all worked this out about me. She's sitting back thinking that's no, you can have as many as you like, really, as long as they are properly client accounts. And in fact, I would say, again, if I go back 30 odd years, all firms only have one client account and one office account with the same bank, plus, I say, one general client account is perhaps more accurate, one office account, and then they probably had a great big load of designated accounts, but it was always just with the one bank. Whereas quite a lot of firms now, for various reasons, will have, might have, client account 1 and client account 2 as general client accounts with the same bank, but also might actually have general client accounts with different banks. I guess, in a way, spreading the risk a bit there, or it helps with those sort of provisions. So as long as it is a proper client account, properly set up, then yeah, there's no specific limit to it, and it's definitely more common. You see firms with client accounts, euro ones and dollar ones as well, depending on who they're transacting with. So just a bit more to reconcile.
Okay, and perhaps another for you then, Janet. How can we run a practice without a client account? We want to close ours down.
Well, I think it's a bit of I refer you to my previous answer to a certain extent. Yeah, basically the best thing to do then is look at the guidance notes around the guidance note around, do I need to operate a client account? So if you have a look at that sort of goes through the things that you need to worry about or not need to worry about in terms of, and then the definitions linked into what is client money. So unless you're going to go down the TPMA route, which it does pick up the TPMA route in that guidance note, that's really the way to look at how you would be able to do it, and again, that way may well often mean that, contrary to traditionally how things have always been done and are still typically done, you may be instructing your clients to make more payments directly themselves to third parties without them transacting, through your client account, which might have been more typical. But that's the guidance note on that, which goes through it.
Okay, thanks. I'm conscious of time, but I think we've got time for a couple more. So, do the client's own joint account reconciliations need to be signed by a manager or COFA?
I think that in the new, yeah, I mean, by inference or specifically under the existing rule, if they were done, they did, because it came under, because the rule for reconciliation says that. But I think I'm right, Taranjeet, in saying that the new rule for the 16-week reconciliation of the transactions, as it were, has to be signed, reviewed by them, doesn't it? And that's all part of the control and review. And I think, again, there's this wording in the existing guidance note around these that, if you weren't able to do full reconciliations at the moment, you still got to take steps as a firm to ensure that you are confident that this money is protected. And the COFA signing it is part of the firm having steps in place to do that. So I think that's probably where we are, isn't it?
Yeah, that's correct. And I think the word reconciliation can sometimes be a bit misleading here, because it's not a reconciliation as you do on the client account. You've got to reconcile those transactions. So you've got to keep records. And like Janet was saying earlier, there might be Excel worksheets, which you then check against the bank statements and your bills issued. But yeah, they have to be checked and signed by a COFA or a manager every 16 weeks.
Okay, thank you. Okay, how are we doing? Can certainly squeeze this one in and then maybe one more after. So if legal aid money is being held awaiting clawback, where should this be held as it's third-party money? We can't just send this back, as the legal aid agency will take it back when it's ready.
I can take that. It's business money, so it's held in your business account or have wherever you account for legal aid money. So as long as you've ring-fenced it within your business account, or if you've got a separate legal aid account, it doesn't have to be in client account. It's the rule change shifted that, so legal aid monies all goes into the business account. I think Janet's nodding with that.
Yeah, no, that's my, I'm not an expert. I mean, I think my other understanding is if that was some sort of payment that had come in from another party on a legal aid matter, that would then go into client's account, wouldn't it? Is that right? So if it's from the legal aid, yeah, which is obviously 99.9% of the time going to be what it is. Yeah.
Okay, and perhaps one final quick question. If you don't have a client account, can funds be sent to the other side's solicitors?
I guess the question is, what funds would you be sending to the side solicitors?
Because I wasn't sure.
Yeah, because if you don't have a client account, the only money you should be receiving are for your fees or disbursements you've incurred on your behalf. If you're having to send money on to another solicitor, it looks like a transaction. To me, it sounds more like a transaction, which means you need a client account. So it depends on what you're doing. The rules only allow you not to have a client account is if the money you're receiving is for your fees or disbursements you've incurred. So if you're having to send somewhere to somewhere else, it's probably you're going to need a client account.
Brilliant. Perfect. Thank you. Well, thank you both. Thank you very much. Really, really useful session. And I did fire many questions at you. So thank you for that. And thank you everyone for your attention. And apologies if we didn't get to your question. There are some that we didn't manage to get to. What we'll do is we'll go through these questions and we'll see if we can pick up any themes and use them in a future webinar. And of course, if you've got any specific queries, you know that you can contact our ethics helpline and they will be able to offer support. All the resources from today's webinar can be found at our on-demand pages. Hopefully you've enjoyed this session. We've certainly got through a lot, but we do want to know what you think. So did the format work for you? How could we improve it? If you can click on the feedback link below and do let us know your views, we'd really appreciate it. So we've got some further sessions being shown this week. This is the last session for today, but tomorrow morning at 10:30, we've got your compliance queries. So do look out for that. And thank you very much and look forward to seeing you again soon. Thank you.